Welcome everyone to our last piece of explanation with regard to long-term assets and liabilities and the unique application of that. And we turn to the most unique, you might say, of those items that we've talked about, and that is notes receivable. And of course, the flip side of that is notes payable, or long-term liabilities, that we'll talk about on the next slide. So we're talking about the lender here who loans somebody money, all right? Now, this is different in that the impairment consideration is different. So first of all, any change in anticipated cash flows means that the note is impaired. There is no two-step process. Any change in the anticipated cash flows results in impairment. What that means is there's nobody that lends somebody money that is going to have an increase in future cash flows. There's no one's going to the lender is not going to be able to compel the borrower to pay more than was originally determined. So the only way that this goes in actuality is it must get better for the borrower, worse for the lender. So there's only one way to go, and that is with an impairment to that notes receivable. And so any change, that could be a change in the interest rate, in the payments, the number of years that's going to be paid, any of those things. If there is a change in anticipated cash flows, it needs to be looked at as impaired. So you then are going to use our good old friend present value to calculate the value of the new anticipated cash flows. Okay? So if there's a new payment, you're going to use the new payment amount in your calculation of present value. If there's a new number of payments or length of time for the loan, that's all going to be adjusted in our calculation. But what is not going to be adjusted is we are going to continue to use the contract interest rate, the original interest rate. That's the tricky part. You need to use that current contract interest rate, not the new one, not what you lower it to or anything like that, the existing contract interest rate. Now, sometimes the idea of this scenario is that you're going to receive some kind of collateral. So with loans where collateral is pledged, meaning you get to repossess as a lender. So if the person can't pay, we're going to repossess an asset. Then the value of the note receivable becomes the fair value of the collateral. So if you can't pay your loan and I'm going to repossess your forklift, let's say, then the fair value of that note receivable under that circumstance, or the impaired value, is the fair value of that forklift. All right? So that's the situation. Now, again, this can only go one way. A note receivable can only be impaired, which means we can only record a loss. There is never a gain on this scenario. It is always a loss. Fair value, or the present value of future cash flow, is less than the original carrying amount. All right, so you're going to do your present value calculations and compare it to the current amount listed on the balance sheet as receivable. So if you show a note receivable for $500,000, you're going to then take the present value of the future cash flows under the new terms, except for the interest rate, which we will still use the old interest rate. And let's say that present value is only $400,000, then you have a loss of $100,000 that you're going to credit to the receivable and debit the loss. Now, the point to remember is what happens almost in every case where there is a note receivable and the situation is bad, meaning the borrower is having financial trouble, which is the only reason why we would negotiate new terms on the loan, is because the borrower is got some problems. If that's the case, they are probably late in making payments or have not made payments for a little while, could be quite a while, several months. When a loan is in that situation, meaning it is what the banks would call non-performing, meaning they're not receiving payments or at least not full payments, interest continues to accrue on that to a point, and usually you have to be reasonable about that, meaning that maybe for 90 days, and then at that point, if they haven't made a payment in 90 days, maybe 120 days, then you stop accruing interest because you figure it doesn't make any sense to continue to add to the loan amount that you're not going to get anyway. But that's on a case-by-case basis depending on the situation. But whatever that accrued interest they owe, that keeps going up without, since payments aren't being made, that is included in the carrying amount when determining that carrying amount and comparing it to the fair value. So your loan may be $500,000 in principal, but you may have to add to that some accrued interest since the last time they made payments, and then compare that to the present value of the future cash flows to determine your loss. So you'd actually have a loss of some of that interest that you have accrued when they didn't make any payments. Now, flip side to this note receivable, for every note receivable in the world, there is a note payable. So we'll consider how it looks on the other side. So you have to kind of twist your brain around, think about notes receivable first if you're the lender, but also there's the issue of how do we deal with this on the note payable or long-term liability. Well, there are some things that are the same, and we do like to have things, for the most part, look the mirror image. So the amount of one company's payable should look like the same amount as the other company, the lender's receivable. That's our goal in accounting. And we see this first bullet point is fair value is present value of future cash flows. We knew that. That's the case. It is case with assets as well. The fair value is a present value of future cash flows. Now, when a borrower has a situation where they either ask for or are granted new terms on the loan, if it reaches a certain level of you might say forgiveness, it's called a troubled debt restructuring. So some of the easier ways that could happen is that the borrower could give the lender stock in their company in return for forgiving part of the loan, or maybe all of the loan. Or they may give up voluntarily, and that's really not a repossession, what we sometimes call a friendly repossession. We basically say, okay, take the asset back and forgive the loan on that asset. So that could be involved with collateral. So there is some kind of a change in terms. Now, on this side, the borrower cannot record a loss. They have to record either nothing or a gain. So they are going to either record a gain or nothing at all on this kind of scenario when the lender is giving them better terms. So here's what we do to figure out which to do, whether to do a gain or nothing at all, no journal entry at all. So first of all, the gain recognized if the undiscounted future cash flows, now this is kind of sounds like our two-step impairment process, but remember this is on the liability side, this is borrower. We're looking at our note payable. If the new terms of the loan is going to result in us paying less without considering present value, just straight cash flows, less than the carrying amount, then we recognize a gain. All right? So we add up how many payments we're going to have to make, not considering present value. We compare it to the carrying amount. It's less than that. The difference between the two is a gain. We're going to debit the loan and credit gain. So we're going to debit the payable, credit the gain. And as we make future payments in the situation when there was a gain recognized on this troubled debt restructuring, and that's the definition of a troubled debt restructuring, is when there was a gain recognized. When we do that, every payment after that is going to be all principal. We will not record any interest. So when we make any future payments, we will debit the liability and credit cash, making our life really easy accounting-wise going forward. However, if there's no gain, all right, then we make no journal entry at the time of the new terms. We simply calculate a new interest rate on the loan that we can then use to amortize the rest of the carrying amount. So we don't change the carrying amount. If we have listed that we owe them, the bank, $500,000, we continue to leave that alone. We do not record a gain. We simply figure out with the new payments what interest rate would make those new payments equal to the $500,000. So that takes a good knowledge of the idea of present value, because you're going to have to use a present value formula and then put different terms into the formula until you figure out what interest rate will make your present value equal to exactly the carrying amount of the loan. And then that's the interest rate going forward you're going to use to amortize the loan. That's the interest rate you're going to use to calculate accrued interest. It's the interest rate you're going to use to calculate how much of your each payment is interest and principal. The overall point of this is when there is a change in terms for a loan, when the borrower is going to have a different outcome, a different amount, and recording a different amount than the lender. So remember, the lender can only have a loss, the borrower can only have a gain, and that gain or loss will never, almost never, I can't imagine a situation where they will be the same amount, unfortunately. We like that, but in this case, FASB left the rules open to the point that there will not be the same thing, and the interest calculation will not be the same. Interest payable will not equal interest receivable after there's been a change in the terms of a loan. Normal loans with no change in terms, they should be, the payable and receivable should be the same, but not in this case.